Morning, everyone. We're just waiting for some more participants to join us. We've got quite a few people on the call this morning, and it's great to be able to do this with you. We really appreciate your time. To those that have just joined us, thanks for joining us. We're just waiting for some more people to join. We've got quite a few participants participating in this call today. So we'll just give it a few more seconds and then we'll get started.
Sorry, it's a technology. There's 400 people who signed up, and it takes Zoom a little bit of time to get everyone loaded. So it's before we start jabbering, and then the technology hasn't loaded everyone yet.
Okay, I think let's get started. Hopefully the more people will be joining. Like Rob says, it does take a little bit of time. I think firstly, just thank you so much for your time today. We know that everyone's screaming for your attention. You know, again, we'd love to be able to see you face to face, but this is the next best thing. My name is Brian du Plessis. I'm head of distribution at Rezco Asset Management. And with me on the call today is our Chief Investment Officer, Rob Spanjaard, and Simon Sylvester, who's head of research and also co-PM. Rob will be flying the plane today. And we also encourage you, we want to make this as interactive as possible. There's a chat box at the bottom. Please pose your questions. Simon will be manning that. We will answer them at the appropriate time. What we're going to try and do, just in terms of the format, we're going to present for 45 minutes, and then we'll have some time afterwards for questions and answers. If we do go over that time, please, if you've got other commitments, please feel free to go, but we'd like to try and get through all of your questions and attend to each question that you have. Just with regards to CPD points, we have got an approval for the presentation. We will be sending that to all the participants at this afternoon or tomorrow. And just some other information or house rules, we will be recording it, and we'll also send a link to a recording of this webinar, as well as a link to all the slides, to the slide deck. So once again, just before I go and hand over to Rob, I want to encourage you to please ask questions. It's great to answer those. And with that, I'll hand over to Rob.
Ron, thank you. And thanks to all our clients, friends, prospective clients, and obviously there's always industry people on these calls as well. It's really great to be able to do that, and you know, between the two, we've got 650 people signed up, which is really it's really nice thing to do, talk to so many people. Obviously, we miss a human interaction, but I think it will saves us a huge amount of time. And we really appreciate your feedback on these presentations, where we could make it better. You know, we did the last one actually in studio at our offices in Sandton and in Port Elizabeth. COVID has sort of wound that back a little bit, so we couldn't do, and we're looking for ways to make it better. But the thing that we found that really does work is if you ask those questions through the presentation. So this is not pre-recorded. And we find it's the standard of the knowledgeability of the audience is really great, and the standard of the questions are really good. And Simon's monitoring that chat, and sometimes he can just answer because he's a co-portfolio manager on the fund. He can give you a great answer on it, and then there's often 3-4 people asking the same question, and obviously we don't answer it 3-4 times. What we will do, as Brian said, is we will leave, the bit of the presentation at the end. Normally you'll end the presentation, a physical presentation, and then there's always a couple of people who it's great to stand around and have a cup of coffee and chat in a little bit more depth. So we'll keep that conversation going a bit longer, but end it very promptly after the hour mark. I think I've covered most of that, but let me get into the meat of this. At the heart of what our thinking on the market is. So there's 2 bits to it. We're going to look at a bit of performance. That's always important, how our fund's been doing. And then where we're seeing the market. I think we've got a reputation of calling it as we see it. And we right most of the time, not every single time, but we're playing a percentages game. And this slide sums up what we think at the moment. We're not out the woods yet. The markets are not out the woods. It tending to feel, we got very excited last week with the Moderna vaccine and the Pfizer vaccine. That wow, by somewhere early in next year, life's just entirely back to how it was. And we don't think it's as simple as that, and we'll unpack our thinking on why that is, and hopefully can add some value to you on that. And there's a very well thought out. We don't just take a view. And we're always also challenging ourselves. Are we wrong? And we have a lot of debate internally. The amount of hours that Simon and I spend debating this, and we're always trying to knock over our investment view. And we build a conviction. We don't start with conviction. That would be arrogant, but we build a conviction as we work towards an understanding of what actually is going on there. And what's the best risk reward options for our clients. And as you've heard our presentations, it's always hugely important to us. It's a risk and reward. Are we getting paid to take that risk? Just talking a little bit performance-wise on the funds, obviously that's value trend, long-term, 16-year track record, and we are playing the long game. So that we're very proud of that record. That's the red line. The yellow line is the peer group, and that's important to us. It's building it over the cycle. Also, just important to note is that we're not doomsdayers. The funds actually do quite well in bull markets. We actually outperform in bull markets. We're not just super negative always. In the 2008 bull market, we did exceptionally well. To 2010 to 2016, generated really nice outperformance. And it's important in the context because we're looking at this object of risk return. Just as a table on that, starting with the 10-year, we obviously longer to 16 years even better, but there's only one fund with that record. 10-year value trend is number one. The 5-year, it's 14 out of 136, 3-year, it's 7 out of 182, and over 1 year, it's 11 out of 208. And that's where we're not trying to win the fund awards. It's really, we're just comfortable trying to be top decile, top quartile. Equity fund as well. It's obviously only got a 6-year track record, just consistently over most time periods, doing really nicely. And then a stable fund, we think, is a great addition. It's a great place for stable fund in this market across the various time periods. And that's what we're trying to do. We're trying to play a longer game. In the context of what I was talking about earlier of risk-adjusted returns, when you think about Rezco, what we're aiming for is that intersect between risk control and alpha. It's usually part of the way we think, the way we operate. We don't start from the point of view we need to beat the opposition over every time period. We want to get risk-adjusted returns for our clients. That's hugely important in the investment decisions we take, and you'll see it in some of the investment topics that we talk about a little bit later. That comes out quite clearly. So that's value trend, 3-year, still outperforming the peer group really, really nicely. Now I'm going to do something a little bit naughty. We're not allowed to talk about mid-month numbers. It's actually illegal from the FSCA point of view to ever present on mid-month numbers. But obviously we've got, we had the market had a massive rally the last 2 weeks, as everyone assumes coronavirus is gone. So as our clients we take a bit of the risk, and hopefully we're not being too naughty. Obviously, we need to talk about like what's the difference it makes. So you can see that's the rally on the peer group. We're comfortable. We obviously want to always outperform, but there'll be periods of time, quarters, half years, where we won't outperform because we're not trying to win every quarter. We'll take risks as we see them. And it's just coming back to the concept of what these slides we've had up at our previous presentations, excuse me. We're trying to get this combination of return. You can see there, this is over 3 years, that the dots are our peer group, and with a lowish standard deviation. Hugely important to us. You can't have it both ways often. So we always, even in this current environment, we're saying, look, why aren't we fully invested in SA Inc? And then we could have had this huge rally. Property shares had a fantastic rally. Why weren't you there? There was a lot of them went up 20%. We're just saying the risk reward isn't working for us. At the same time, what really is valuable to our clients is that the risk is low, but the standard deviation, the risk is low, it's low standard deviation, but the correlation is quite low relative to other funds. That means it combines really well with a lot of really good competitive funds out there. But we sometimes can't have it both ways. There'll be a week like last week where the market really, really pops, and we might not be there for it. But that's very much consistent process. We're not trying to get a 3-month return is not what we'd like to win every 3-month period, but it's really not the investment problem we're trying to solve for at Rezco. So you combine the two, you get this better than most peers return with a lowish correlation. The point is, I think a lot of experienced investors out there, when a fund's just had a blowout quarter, is probably not the time to invest. When it's had a slightly weaker quarter is actually the time to invest. We're not chasing 3 months returns, and we know a lot of our experienced clients aren't trying to do the same thing. You're looking at this bigger picture. That's our Managed Plus fund, very similar picture to Rezco Value Trend. Our stable fund just tried those very smooth returns, also just going along really nicely. And our equity fund obviously has to be fully invested, so it did participate in the rally last week, the big kick up in the market. You're just trying to find the best selection of South African only equities, and it really does talk to the stock picking skill of the team. Myself, Simon, then our research team, identifying the very specific opportunities out there. Getting onto the investment markets. So we can frame it like that. We thought like, well, it's always get the image of a bit of a boxing match. On the one hand, you get this maximum stimulus, QE, fiscal stimulus. In the other side of the ring, you've got real economic damage, very expensive markets. We're not dealing with a market that's at 2010 levels. It's markets that are like record highs, very expensive. And then the other point is the virus impacts are here till mid 2021 at least. So it's a sort of tussle between the two, and it'd be great to share our thinking of how all this unpacks. So there in the stimulus thing, on the left-hand side there, you can see the expansion of central bank balance sheets. The big kick up this year is about $12 trillion of new quantitative easing, money that got printed. The expansion in the budget deficits of the major economies, the G4 plus China, so Europe, America, China, you've got these massive budget deficits, and that's about 10 trillion expansion. So it's similar. Essentially what you've done on a large scale is you printed $10–12 billion and you've just run massive budget deficits. Now that's powerful. You have the saying in our industry, don't argue with the Fed, don't argue with the central banks. Sometimes it's true, but not always. And there's some counter arguments in it that you've just got to be a little bit careful of. And partly in it, like what can go wrong. So starting out, this is the red line there is the European Central Bank's quantitative easing program. Over quite a few years, they really grew it. Even if you look from 2014 here, they pumped the balance sheet. They printed a lot of money. And if you look on this graph, it didn't necessarily translate. If you look from 2014, so that was that zoomed in part, it didn't translate into high equity prices. Equity prices need a recovering economy, they need earnings growth, they need actual company fundamentals. That's certainly what we believe. Company fundamentals do matter, and it over time it does. So on its own, just because there's liquidity doesn't necessarily mean shares go up. Then there's another thing. It's a very interesting book that was written after the global financial crisis by two Harvard profs, Reinhardt and Rogoff. This was a book called This Time It's Different. You can see 8 centuries of financial folly. So we didn't look for 800 years of all these things. Printing money has been around forever. Quant QE in various forms is one of the things that have been around. And ultimately, there are risks it ends badly. And why? Because it starts out small. And then it becomes like, wow, that was easy. So there's things like cutting the corners of coins. It seems easy, and you do it more and more, and eventually it ends badly. And this is the point on this slide. You can see US money supply, the amount of money in circulation. It's up 21% year on year. Now, if you just look over here on the middle of the graph, 2010, that's the global financial crisis. It's double the GFC. And the point is just massively pumping your money supply can have big unintended consequences down the line. That's why certain, particularly on the Republican Party, they're a bit reticent to do another massive stimulus. You've got to be a little bit careful. Otherwise, you've solved humanity's great needs. You don't need to tax anybody. Governments don't need to borrow. They just print the money and give everyone a handout. And clearly, intrinsically, we know there's a problem, but it also explains why 2010, the first version of QE 209, 2008, 209, and then over here, we got away with it. But ultimately, it just becomes so massive. So it's a little bit of caution that QE solves, and still big budget deficits solve everything, because ultimately, a lot of these countries are going to put up tax to pay for that extra debt. And there's all sorts of consequences there.
So Rob, just to jump in there on QE, I think it's important not to get sucked into the thinking that because it worked last time, GFC, it's going to work this time and it's going to work next time. The problem with QE is it's cumulative. So the tension in the system is actually building up over time because they're not unwinding those balance sheets. Yeah, so you see on that chart on the left there that QE is cumulative, and that so as that builds up, the tension gets worse and worse, and you probably have to do bigger and bigger QE. If you look at the magnitude of this QE versus the GFC QE and the speed at which it came, so that's why the risk is building up in the system, and we've got to be quite careful not to become too complacent around the theme, in that because it's been around for a while, it feels like QE is just normal monetary policy. It's just the way that economies work. You use QE when there's a bit of a problem. So we're very cognizant of the negative tail risk that this huge stimulus creates, and we're watching that closely. And I think all investors should be really concerned about kind of the risk of a market dislocation because of this QE.
Well, one of the things over here in 2008 to 2012, the Obama administration got very aggressive with the banks on how much cash they had to have as spare reserves, actual physical cash reserves on deposit to the Fed. So a lot of the initial QE actually just went straight back to the Fed as deposits, bank deposits, in building up their cash reserves. And there was a huge shift that. And not so much now. So if this money starts circulating in the system, it can be very inflationary, which then you've got these massive deficits, and you can't print the money anymore. If you start getting inflation, you've got to start mopping up the QE, which can be very, very bad for investment markets. So we're a little bit concerned. In the other camp, so the other side, so we've got stimulus in the one hand. That's great. Stimulus. Everything just there's so much money in the system, it drives markets higher, and interest rates are really low. Very good arguments. We're not saying that isn't a factor. Competing, there's some of these other ones. The first ones, there's very real economic damage. So that's US GDP. You can see at the moment, it's going to end the year down 3.5%, which in perspective is not much different to the GFC. We were initially expecting a lot worse. If you see this dip down here, the year on year at that stage, that was the worst since the Great Depression. But the market's also looking at these sequential changes and saying everything's back to normal early next year. And it's not really the case. I mean, if you look at South Africa, it's even worse. That's Q2. It obviously rebounded, but we were in a recession before we went into this thing. GDP doesn't just jump back to 5% growth. And you can see in the South African context, the blue line there is gross fixed capital formation. That just went off a cliff. So hence we're a bit concerned on some of the SA Inc. shares. So it's not all doom and gloom, but we just face the reality of this very, very, very real economic damage in the context of markets that are at record highs. This is another graph we did. It's just really saying the expectations of where the GDP is going to be at the end of 2021 is significantly, it's 3.5% in the US's case, lower than the expectations were at the start of the year. Just another way of looking at the same thing in the context of markets at record highs. You've got a world, yeah.
Sorry, Daniel Vessels just asked you a question just to bring in inflation into the conversation, given all this QE. And so Daniel, yeah, it's an important question, inflation, and we didn't put a specific slide on it, but the big risk of QE when we say what could go wrong is inflation coming through, and we do think that over the medium term, that there's significant risk that inflation comes back quite strongly. The problem being is that the economic growth is not that good either. So you could have a bit of a stagflation environment, because if inflation comes back, central banks have to hike interest rates, and then you don't get that recovery that's built on zero interest rates. So it's a significant risk that inflation comes through. And specifically in that QE, if this time that money gets circulated in the system, you're going to see it in inflation. It's going to come through eventually in inflation. We think medium-term risk, not even it's not a long-term risk. It's a near-term risk, but in the context when a more recessionary type environment, it's hard for inflation to be very strong when the economy is weak. So it's in that kind of recovery of the economy, but if inflation overshoots, interest rates then hike and you actually kill the recovery.
We have the view of that this massive QE is analogous to a person with a drinking problem. Initially having a drink makes you feel a bit better. But eventually consuming more and more drink, or maybe even take an example of someone taking drugs or sleeping pills, or you're just taking more and more. I've never experimented with this, so I talk as a novice. But the problem is you're just taking more and more QE to get the same impact. And that's ultimately where it's almost like addiction of the markets, but ultimately it breaks. You can't, and as soon as you start getting inflation, China was this massive deflationary force on world markets for a long time. And you crank your money supply by 20%. And if your velocity of money slightly picks up, you've got a major inflation problem. You can't do QE. That means the governments have got to start to mop up some of the existing QE, and you've got to start running. Your government debt starts becoming a major problem. This is also interesting. This is the consensus earnings forecasts, and we just use the US market as an example. 2 years later, you can see tech companies and the tech and healthcare, the earnings are about the same. You 20% growth that you're expecting over the 2 years, 10% a year roughly. But the share prices have gone up. So the real reality that all the tech companies, the share prices have gone up probably about, I think on average about 30% this year. But the earnings over the 2 year period are no better. But you're paying 20-30% more for those same companies. And a lot of these industries, sectors, the earnings, if you look at consumer staples or the financials, so the industrials or the financials, earnings are actually now 20% lower. So it's concerning the level of the market, given what's happening there. So that's getting on to the next thing. We have got expensive markets. A lot of investors, we feel, making the mistake that they're playing the 2009 game again. So just go berserk in 2010, buy anything, particularly stuff that's done badly. and you make a fortune of money. Now, this is just zooming out, this is a 150-year chart of the S&P adjusted for inflation. So it's in real terms. Now, a couple of things noteworthy. It's good to sometimes just step back, zoom out. Actually, even this Corona crash wasn't a bear market yet. So we actually 12 years into a bull market. So all sorts of excesses build up. GFC, you can see look at the bear market. That's why it was so great in fact, that was 2000 right through to GFC. It was a great time to buy equities. Zooming in a little bit of that, you can see how cheap equities are. That's the 18 months forward price earnings ratios, good measure of how cheap the market is. You're getting cheap equities, over here, even cheaper. You were paying 10, 12 times, and interest rates were naught as well. Interest rates were also zero at that stage. It's not that you should use a different discount rate. We're now getting in the same environment, but equity prices are at records. So over here, what did we do? We filled our boots with equity. We had and we thought, oh, great, the risk return in 2010 start to fill up. And we had a great run through that period. Over here, we're saying that we don't think it's that simple. I think you've got to be a little bit concerned. This is just one of the things in the opposite camp to pumping liquidity just drives everything. We just think people have got to be a little bit cautious here. Even if you strip out the tech companies. So a lot of people look at this, say, yeah, but the tech companies have done so well. Strip out the tech companies. There's the S&P excluding the tech companies. And there's a lot of companies, there's airlines and banks in that lot as well. That market's also recovered to a record. This is quite interesting. If you take the S&P and you see the earnings, where are the earnings? This is the historical actual earnings. It's the actual earnings of the companies in the index. They're down here. So in other words, based on current earnings, the S&P should be about 2,200 relative, in other words, back to where it was just after Trump came into power, about 30%, 40% lower. Okay, the earnings are going to recover, but based on consensus, earnings are only going to be back to these sort of levels on that. So the dotted line is earnings over there's earnings in 18 months time. You can see it's not back to these levels. So you've got a bit of a gap here. Sometimes the problem is that the market actually discloses those gaps quite quickly. So the previous graph over here showed the same thing. Very expensive markets are dangerous places to play. The same argument in .com here. Yeah, it could carry on running. Everyone knew, wow, it's expensive. But then you ended out, the danger on that is you went basically 10 years till you got there, actually about 13, 14 years before you made any significant money on US equities if you just bought the index. That's the danger on playing in very expensive markets. And you had a whole lot of pain during that period. South Africa, similar thing. We don't think the South African market's cheap. That's the forward price earnings ratio of our market. We're not in super cheap territory. Even if you strip out NASPAS, our market is not. The historical PE is actually quite high. Okay, so we're saying the market's so expensive. There's real economic damage, and COVID. Let's just talk this COVID thing. It's doing what we expected in May. So when we chatted, we had some of these graphs up. It's always good to take an old presentation and pop it out. We showed this graph. There's some graphs out of a thing called SIDRAP report, which is epidemiologists put it out. Their main scenario, they said, look, very unlikely scenario 3. Could happen, anything can happen, but we're pretty much between 1 and 2 big surges and having to lock down, like surge lockdown. Most likely scenario is a surge going into autumn, winter in the Northern Hemisphere. So that was expectation at that stage, pretty much what you see. So huge surge in Northern Hemisphere. On the vaccine news, so this is from May. The front runners were Moderna, Biotech, and Pfizer. They reported last week. Expectation was first quarter So that's a bit earlier for Pfizer's vaccine. But it'll only be approved by the end of the year. So you're talking a quarter earlier, and then middle of the year before you vaccinating, doing mass vaccination. Initial, end of this year, we talk emergency use, healthcare workers getting it, frontline. But it takes a while to get massive scale that you can open up your economies. So it's a little bit earlier than expected. It certainly was never a surprise that there was going to be a vaccine, because there are 60, 70 of them in production. It just the amount is you've got to vaccinate a couple of billion people to really make a difference.
And just on the vaccine, just some of the market's looking quite simplistically at the news, and possibly also from a human hopeful context. I mean, we're glad that the vaccines are looking like they're going to be more effective than what was expected. But some of the details, just anecdotally, there's those vaccines that are coming out towards the end of this year for emergency use, frontline workers. You need 2 shots, and they're 28 days apart. So just by the way, you get your first shot in December, you get your second shot in January. End of January. You got to shift the whole curve out. I think some of the commentary feels like COVID vaccines pretty much here, but even if you just factor in the 1 month gap between the 2 shots that you have to take to get the full vaccine or the full effect, there's a lot of detail in this, and I think the market's missing it. And so there's probably all the good vaccine news is in the price, and as more data is released, as rollout programs, timelines are released, probably a little bit of downside in the timing, and all the good news probably in the price when it comes to the vaccine.
So what you're seeing is this even if it was just vaccine and the case numbers were low, sorry, excuse me, but what you're seeing Northern Hemisphere, where it's winter now, you're seeing this massive surge. So even Sweden, who didn't do lockdown first time, are having to do lockdown or really restrictive economic activity. So Europe skyrocketed. Even you see Europe cases have come down a little bit off that peak, but that's as a result of being more restrictive. So now when you get this numbers right down, and there's a month or 2 away till you've got a vaccine, or you as a politician going to say, okay, guys, let's just open up. Unlikely you've got restricted economic activity, very real damage to a lot of these companies. That's what we're saying. It's not, it isn't just like as of last week, we're back to normal. There's massive damage to balance sheets. If you're an airline and you're going to have another 6-9 months of pretty much no activity, you've got a major problem. And you're starting to, so the impact of that increased, that virus surge, increased coronavirus, you can see in the European PMI'S, that's Purchasing Managers Indexes, short-term measures of economic activity. You're seeing that rolling over in the EU. What's important here is when these things go below 50, then you're going into contraction. In other words, does this month feel worse than last month? And that's very much what you're starting to see, a lot of other high frequency factors. And you're seeing a similar kind of thing in the US, if you look at credit card billings, a lot of that stuff. Now, the market got very excited on this short-term recovery. And that's what we don't think it was pure liquidity that drove it. We just think it's the market said, yeah, okay, everything goes back to normal. We can start buying this market. The PMI'S roll over. You've got, and a lot of other high frequency indicators. That's not the only one we look at. You've got, with markets at record levels, you've got more downside risk than you have got upside opportunity. Just where we positioned as investors, where do we have our clients' money? It's actually quite interesting because that's value trend, the long-term asset allocation, and the red is equities and commodities, and then the yellow or mustardy color is bonds. We've got we've actually got about 35% in bond duration now. There's an interesting reason for that. It's not that we dislike bonds, and we'll explain to you what our thinking is there and why we're doing that. We don't think the risk reward stacks up nicely in equities, local equities, SA Inc. the mining shares, we really like this set. They're really, really cheap. We've done a lot of detailed research. John Williams was head of commodities at Anglo's. We've gone into the detail on the platinum markets, platinum, palladium, rhodium, and those markets are very, very tight for a couple of years. So those companies will make some very, very significant cash flows and are very, very cheap, even if auto production is slightly down. Okay, so the interesting, we'll get into the story on the bonds, very similar thing in our stable fund. And why this is, okay, so that's the difference between what you earn on a South African 10-year government bond, which now is the SA 2030, and what you were used to get on money market. That's a proxy for money market, which is, we've calculated it's give or take 20 bips, because those rates do fluctuate slightly. Now our point was over here with our spare cash. We could own money market and not be paying much of a different, not be losing much cash yield relative to a South African 10-year government bond. On top of that, we could buy floating rate notes from top quality banks like Standard Bank, First Rand, whatever, Investec, all of those out there. And you could be getting your 8.5%. So you didn't really have any yield pickup. So what are we saying? You went through an environment where we had the Zuma years, ANC elective conference. You pick your years of concern, and you weren't really getting any investment premium. You weren't really getting, and sorry, that big other one I mentioned as well, South Africa being downgraded. You remember that story? When do we come out the WIGB? When do we get downgraded to junk? You had all those risks you had to live with, and you were getting kind of 1% to 2% more than you got in money market. Now, in our risk-based approach, doesn't really work. Doesn't make sense to do that. At the moment, you now get 5% more in a 10-year government bond. Now, that does make sense to us. That has got some attraction. So we've got some duration now. You've got to be a little bit nervous of the trade though. We're always trying to look what's going to go wrong, and two things sort of come out on this next slide. The first one you can see there's a total return of the R186. That's a South African government bond with about 6 years left to maturity. It's got reasonably shorter dated now, but you can see even there, look at the capital loss that you had in the Corona crash. So something goes wrong in an emerging market, bonds can give you it can give you a capital loss. But over time, they've beaten the South African index over this period of time. That's why we would rather own a bit of duration than South African incorporated companies. Now you can have the week like last week where property shares pop 20 and a lot of the retailers go up a lot. But if you look at the fundamental picture, we think they can give a whole lot of that back again. You can have some advantage in holding government bonds. Now the danger of the problem is in an income fund, if you're not going to take any risk, down at the money market side, the very short dated, you're getting about 3.9%. The money, so income fund, which with a lower risk, you're getting 5.5%. The risk of putting everything in bonds, we think, is just suicidal in this environment. You can't do it. But being a balanced fund, we can shift a little bit more to bonds and get a return on it. And the reason you've got to be a little bit nervous at the moment is that's the amount of debt somewhere between these two things. So at the medium-term budget speech last month, we're somewhere between. That's the trajectory. But those are Minister Mbowene's scenarios from earlier in the year. So they've got to place 800 billion or 700. Currently, they're estimating about 750 billion rands worth of government paper over this year, dropping to about 650 next year. In the environment where foreigners were aggressively selling our bonds, we're a little bit worried. Wait, see if foreigners can when they finish selling, they seem to finish selling, and we managed to handle liquidity and all the extra issuance. So we would. Sorry, Karen.
So I just wanted to emphasize an important point. You've made it, but I just want to emphasize it as we see South African government bonds as a risk investment. We also see SA Inc. equities as a risk investment. And it's our job to work out what's the better risk to take, what's going to get the better risk adjusted return for our clients. We don't kind of think that SA government bonds are this risk-free, just lend to the South African government and you'll get this fantastic return. We do it with careful analysis and caution. And we also note that you can lose money in government bonds. And we'll talk on the next few slides why we think, SA government bonds with the current yields are a better risk return option than South African Inc.
Yeah, so getting into the meat of that, the point Simon's making, just to reiterate it probably for the third time, government bonds with duration are a risk asset. You're taking some risk. So for us, we need to be saying, look, what the other options? A money market is essentially with the top banks, very low risk in South African context. But a 10-year bond, because if the yield goes up, you have a capital loss. 20-year bond, even more so. Obviously, you get an increased return if the yield goes down. So there is a risk element in it. So if you take it like a little bit of a case study here, which unpacks our thinking a bit, the yellow line here is Standard Bank's earnings growth and the dividend that you get paid. So we're saying, look, roughly as a shareholder, you're getting this earnings growth and a dividend. So the share's going up in value. And you can see the red line is kind of what the return you made on Standard Bank. Great company, good bank. We like Standard Bank. But you can see your return is actually correlates quite closely to what the earnings growth of the company is going to be, plus the dividends they pay out, and that you would expect. Now, here's the concern. You can see there's your 10-year government bond yield, South African 10-year government bond yield. Previously, Standard Banks, the earnings plus the divvy, that's why you could earn close to 20%. That was great, lovely environment to invest. And clearly, while we would say, well, why bother to own the 10-year government bond? With our spare cash, we would own money market because the return you're getting wasn't much worse than the government bond. And you've got to take risk on a government bond. So much rather use your risk bucket on owning something like Standard Bank, which we've held quite a lot of it at times. And that was clearly a much better play. Where you are now is it's inverted a bit. The earnings are constrained. We don't think the banks have fully provided for the loans that are in the system. And so they're going to struggle to beat the 8-9% that you're going to get on the 10-year government bond. You reiterating for the final time, don't go and stick. We don't think income fund is the smartest idea. Go put everything in 10-year government bonds, because you might say to me, Rob, why don't I just put everything in a 10-year government bond? And it was like, guys, this slide, the amount of stuff that the government's got to actually issue, and we're an emerging market, you can take a capital loss if something goes wrong in this context. And that comes back to the core part of where we think we add value to our clients is this wheel that we've shown on many occasions, that we can rotate between these various asset classes. Sometimes the best place to be is in local equity, sometimes global equity, precious metals, local bonds, foreign bonds, property, and you don't have to only have one of those. Obviously not. You have the right proportions of those asset classes with your money, and you can see this is this stack chart, and going to the last year, we did really nicely on our fixed income. Your local fixed income did pretty great. Your that's a local. There's your foreign over there. So bonds, a lot of that's currency driven. There was some capital appreciation there as well, but you got great returns on your bonds in this environment. So as Rezco as a house, we're prepared to rotate, and at times we'll make a lot of our return there. And that that's why we're sitting on about 9% return year to date till the end of October. Our peer groups -3. And it's being able to you just need to cleverly rotate, not super aggressively. We're not taking huge positions and swinging the stuff backwards and forwards. Obviously, our size does help us. Being a mid-sized manager, you can do the analysis, do the work, and rotate those positions and work out where do you know as the facts become apparent and give you a clearer picture. So back to this thing, maximum stimulus versus real economic damage, a very expensive market. The SA is not as expensive as international, but particularly US, but relative to what you're getting, it's scratchy, and the virus impacts are not just fully gone. They're sitting. It takes a while to make an impact. So where do we see this going in the next year? And those of us, we like to think in probability buckets. So we see a range of outcomes. So roughly a 10% probability of the market tracking this trend. So if we look at the table, 10% chance of the market going up 15%. It certainly can happen. And these aren't exactly, it's not to the exact, you could argue, why haven't you got a decimal point here? This is, you've got, it's your best judgment of how we're seeing the markets. So market can pop higher. Against that scenario is, I don't think the central banks really want to fund equity bubble, because they know where they're left with a hangover if you get excessive risk taking. On top of that, you also had Donald Trump, who many people believe lost the election. Certainly I do too. Let me pay that disclaimer. And Donald Trump believed his popularity could be measured by the S&P. That was his viewer ratings. And he would do anything to keep pumping it. It's not going to work like that going forward. So there's a 10%, we see a 10% probability of that. The problems we see probably a 60% probability of this ranging market. And the return there is 5% because -5 because we think we're at the top of that range. So you're in this range, you'll get hugely optimistic and come back down again. And then 20% chance of a new bear market. That's there, and a crash. Now the crash is painful first 6 months, but then probably recovers. And where these, how this plays out, it probably should look at the 30% chance of some big downside from here, and not a lot of upside. And we're still really comfortable with that positioning based on how with the case we put forward. And this is not just a marketing presentation. Simon and I always like to use these. Say, look, always querying your position. Why are we thinking? What pictures, what graphs, what thinking, what debate? And obviously, we actually track thousands of graphs. We would keep you about a week if we took you through everything we look at. But what's a core to our argument? And we're pretty convinced that you've got to tread very carefully through this environment. Back to Red Riding Hood, there is some risk out there. You're not risk-free out the woods. Go back completely to normal. That we think that would be, certainly we don't want to do that with our clients' money. And we're happy at a short notice if we feel these risks are cleared up and gone, or the market's a lot cheaper to change that picture. But it just would urge people to be just a little bit cautious. On that, often as investors, we putting your monies in funds we actually think it's a really great time to put money in Rezco's funds. When you have a blowout quarter, obviously you collect assets. Strategically, it's probably not the time people should move money. It's a great time. There's a little bit of underperformance over the last 3 months. Still ahead for the year versus most of our competitors. But it's actually a great opportunity because the market's going to have to wrestle with these risks. It's not just all blue sky. We've very accurately landed on the 45-minute mark. So we've got great time. We've got time for questions. If you haven't sent those questions through, encourage you to do it. And I'll pass the mic over to Simon and you can see what's coming there on the screens.
Great. Thanks, Rob. So, I'm manning these questions. We've had quite a few during the call. But if you just hit the Q&A button and ask questions there, we've got a bit of time. And we actually really enjoy going through these questions. So, feel free to push them through. Just one of the questions that comes up often, Hercules asking just about this, we look at fundamentals, fine, But what about all the cash that's moving around worldwide? There's just not enough assets for this cash to find a home. Now that, obviously, that's a really important point. Liquidity can drive markets up. But bear in mind that it doesn't take a lot of liquidity for a market to fall. So markets can build up and get overheated with liquidity. But once the money's in the market, you just need new buyers to stop buying and a few sellers to crash the price. So liquidity is a dangerous thing, because that's why markets have these crashes. As the bull market builds and builds and builds, and then you have this big correction. It doesn't take a lot to make a market crash. I think that's the important point here, is that relying on liquidity to drive a market up is a bit of a hot potato game. What you really want is good economic growth and earnings growth, because then the valuations are supported as the market goes up. But without that, you just get a volatile, risky market, and that probably is a little bit more what European equities look like. There's a lot of liquidity in Europe. You've got negative interest rates in Europe. Yeah, I mean, Switzerland just prints money and then buys equities. So buys sells their currency and then buys foreign equity. There's a lot of liquidity around in Europe. But the markets aren't trending up because you actually need fundamentals. And so liquidity on its own, we think, is a dangerous way to invest hard-earned money, because it can be taken away very quickly when the liquidity dries up.
We very much see that as that's the whole point on what we're saying in the presentation. It's the huge point on the one side of the scale, and we're contrasting it to the points on the other side of the scale. And a lot of this recovery on the market's been on earnings have been slightly better than expected. And there's a sense of economic recovery. If there's a bit of a second dip, you can give that back quite quickly. But as in terms of a case study, if you look at this, and I sort of touched on the slide, but just bringing it again, 2014, you can see how the Europeans cranked their balance sheet very, very significantly, from about 10% of GDP over this period to 22, 23% of GDP to the start of the year. If you look at this, now so that it's sort of a zoomed in period from here. This other graph here is from 2006, but just that zoomed in part, they doubled their balance sheet. There you can see the ECB doubled it. Equity markets didn't really go anywhere over that time. And the interest rates were naught, pretty much zero, and even negative in a lot of the big economies. Negative central bank rates and that as well. So yes, it's a factor. Certainly can make a difference, but you've got to be a little bit. It's not like night follows day that automatically does that. And it's also a two-edged sword, liquidity, because in 2018 the Fed was starting to try to reduce their balance sheet from 4 trillion to 2 trillion, 4.5 trillion to 2.5 trillion. And the market had a very, very severe reaction. It was down about 15% for the year. If the Fed, for some reason, the central banks have to sort of mop up the liquidity, you've got a problem. And it's this concept of a bit of a junkie. You know what I showed on the money supply. You can't just keep doing that. You know, that's in economic terms. It's like a person drinking 3 bottles of whiskey before they go to sleep. I need so long you're going to do that for. It's not you've got a problem, you can't carry, and that liquidity is in the system. But certainly is a good factor, but we're weighting it against the others. The risk reward just says be careful of it at the moment.
Great. Then a question from Michael Ailey, just asking about the global fund's performance. Obviously, the recent underperformance, Michael referring to the feeder fund. Obviously, yes, Michael, the ZAR strengthening in the feeder fund comes through directly, but I'll talk to the USD performance of the global fund underlying that. And that kind of recent 3-month, I think, kind of in July, early August, I think is when it peaked and it rolled down, if I remember the graph perfectly. What's been the reason for that underperformance? Sorry, in the chat I did answer, but there isn't duration. There's no duration. Although there's a lot of US government bonds, they're all very near dated government bonds within the global fund. So it's not a duration thing. The fund has kind of rolled over a little if you look at the performance. It hasn't fallen. And the reason for that has been the funded exposure to precious metals, gold and PGM. It still does. And there was a kind of a big rally in gold and PGM equities into the middle of the year, and they've given back a little bit of that return in the most recent months. That's kind of the core reason for a little bit of that underperformance in the fund. And then, of course, the difference between the global fund and the local funds is in the local funds, we can earn a decent interest rate for the cash sitting on the sidelines. But in the global fund, when you're not getting returns from a small equity allocation, you're not really getting a lot of return elsewhere, because the interest rates on the short-term government debt and cash and so forth are earning zero. That's not to mean that we can't get returns from the fund. I mean, we talk about that active asset allocation, and we'll move it around to get returns. But just to answer your question directly, because you asked it directly, those are the key attribution reasons for that underperformance.
Yeah, we track a peer group of about 180 UCITS flexible funds, which is a peer group for that fund. We're slightly better than peer group. We're not happy with that, because obviously we want to be way better, and we think we should be. So it says lagged a little bit. We're working hard at really trying to improve that. And yeah, we're comfortable to be we're still being fairly the same philosophy as we're employing here. It is a flexible fund. It has a flexible asset allocation as well. So it had much less. It had very little equity, and the equity it did have were the precious metals, which gave a little bit of their gains back from earlier. But it's a little bit ahead of the peers. But we obviously expect to be top decile, top quartile.
And then just on a similar theme, Troy Donaldson just asking a question, just noting that we've got a large allocation to money market type instruments. The offshore cash doesn't earn any interest, and we think equity markets are expensive. So the obvious extension of that is, where does the return come from? How are we going to get any returns in that scenario? And I think it's important, because this question comes up often. So you kind of look at a fund fact sheet and you see what the fund's invested in, and then you extrapolate that allocation to get to some kind of, where does the return come from? Now, it's important, if you understand Rezco, where we're different, a lot of the return comes from the fact that we move that allocation around. So when you pull up the fund fact sheet and you say, well, there's only 5% equity, therefore we can't get any returns, or so forth. I'm not sure if this is exactly what you're asking, but I think it's a question that comes up often. Then where do the returns come from? And we don't have that static asset allocation where we move it around tactically by a small margin. What we do is we move that asset allocation around, trying to manage the risk return as best we can. And so the returns aren't always going to come from exactly what we currently invested in. So no, USD gives you zero interest at the moment. We're not planning on getting returns from USD. What we're planning on is allocating that capital to the right risk return assets at the right time to generate good returns through the cycles. And so that's important when you look at our funds. They're quite different in that regard. Similarly, locally, at the moment, we think that, so we've moved into some local currency duration. So we get government bonds, 10-year, say, government bonds, where you're getting an almost 9% yield on that. We think that's a good return in this current environment relative to other opportunities. And then, of course, on the equity side, we like bull markets. We would love a good bull market. We love good economic growth, and we enjoy investing in shares that are compounding returns. So we're sitting on cash, not because we're permanently bearish. We just don't think it's a good risk at the moment. But at the right point, again, we continually searching for good equity opportunities, and we'll take them when they become available. But we're not going to invest just because the market's going up, or just because there's a lot of cash going around. They need to be good risk return opportunities. I see it's 10:58 now. We often, we say after our presentations, normally we'd be hanging around having a sami and a coffee with everyone. Unfortunately, we don't get to do that, but we're happy to hang around and chat to everyone casually for a little bit longer. That being said, I'll probably hand over to Brian quickly for a minute, just for some formalities. But yeah, don't hang up if you still want to keep chatting. I'll keep going through the answers and questions.
Yeah, thanks, Simon. Guys, yeah, like Simon said, we'd love to answer your questions. If you have to go, we will be sending out the link with the recording, and then we will also be sending out the CPD certificates. So thank you very much. If you have to go, please feel free. If you have questions, please email myself, Brian at Rezco, or Dale at Rezco, or Henk at Rezco, Jacques, or info at Rezco, and we'll get, if we haven't answered your question and you do think of another question, please email that question through to us. And we would also love to set up a call with you, whether it's in person with one of our investment specialists or via Zoom. That would be great. But if you have to go, thank you very much for your time.
Great. So I've still got lots of questions here. So as I said, we're happy to keep chatting for those that want to hang around and chat for a bit. James has got a question, a double-sided question on the changes happening in the auto industry with regards to electric vehicles. See, James, you also mentioned hybrid, but the key thing is pure electric. Hybrids actually still use PGMs, interestingly. So what's these dynamics? How are they going to impact markets? And then similarly linked, James then said, what about South Africa's motor industry? I'm more worried about South Africa's PGM industry than motor industry with regards to moving aggressively into electric. So James, that's something we look at closely, because you'll notice in our funds we've had and we still have a big position in PGM miners, and obviously electric vehicles purely are competition to PGMs, which are used in combustion engines. And so that's a really important question. We've modeled in very, very sophisticated detail. John, who's commodities PM, has built very deep models in recycling and car parks and GDP growth and all the linkages. And we think that this theme is playing out, and it has accelerated, but you've got to be careful of base effects and size and so forth. And so 5-10 year view, the impact's going to become larger. And I think we should be careful from a risk perspective how this changes the dynamics for PGMs and also for our local auto industry. I don't think we're there yet where we're producing electric vehicles or have the capacity to do so. Maybe that will change, but I don't see it changing just yet. So that's probably a headwind for South Africa. So James, I'd concede on to that one, or I'd agree with you on that one. It's a headwind to South Africa. We've got to be careful of it, but also careful of overshooting on themes where everyone gets excited, and actually when you run the numbers, the way it plays out is a 10-year, 15-year type of story. But we're certainly cognizant of it when it comes to the PGM exposure. And there's also the caveat that at the same time, fuel cell is getting increased attention globally and a lot of investment globally, which of course then becomes a new demand driver for platinum. So you've got to tussle with all of that. And the key thing is to have a really good model. A really thoughtful, sophisticated model, because for your brain to work out the different directions of all these moves and to get to a decent answer is quite hard. But actually, when you start plugging it into a model, which is what we've done, you still get deficits. Even factoring in electric vehicles, you still get deficits in the medium term and short term, even bigger deficits in PGMs. And that's why we've invested in PGMs. We're cognizant of the EV trends, but we still see the deficits in PGMs. Okay. A nice question here from Spalding. This idea that the best portfolio is South African fixed investments, and I'm assuming with duration, so you're getting some return, you're getting your 8%, 9% return, and then equity offshore. So you kind of got this barbell approach, and maybe some gold included. We largely agree with you. And that's kind of how the funds are broadly positioned, except I would have the caveat, Spalding, that within the SA space, kind of precious metal miners, some of the global diversified resources shares, the non-SA shares on the SA index, in the SA universe, would be considered global equity, even though they're listed here, or even are a mine here, like a platinum mine. So I'd add that to the kind of global view. We think SA's economy has headwinds. You're getting a good yield on government bonds. Why take the risk on a South African equity? Global equities relative to South African equities are probably in a better space. So I broadly agree with that, but there's always caveats and stock picks and so forth that it's not as purist as that.
Global equity, I mean, it's another asset class which is sort of implied in that is foreign currency. What you then do with the foreign currency is an important issue. That's why we think balance funds have got an advantage over just pure income funds. You're taking that benefit of that optionality up to 30% offshore in a fund that you can do it. At the moment, we do think equity markets internationally are expensive. If you believe equities only ever go up, but history tends to indicate they don't. In reality, there's that saying which we're always going to come back to, of in the short term, the market is just a voting machine. Things just move just because more people want to buy it. But while we're in this game, we think ultimately in the medium term, the market is a weighing machine. Reality matters. How expensive companies are, how those companies are doing, what's their earnings growth, translates into equity prices. You can't. We're firmly of that belief. And you can't, over time, as soon as that was a mistake in .com. It's like, nah, you don't value companies like this. It doesn't matter. None of it matters. It took you 14 years to get back to on the S&P where you really were getting any noticeable appreciation on your equities. And that's a danger on that. So you want to be flexible. You want to rotate. You want to be adaptable. As I said, internally, we're always trying to see where we're wrong. We don't wake up in the morning saying, look, we pig-headed, we entrenched in a position. One of our core views, the most important thing you've got to avail yourself as investors, you've got the right to change your mind. That's hugely important. But we just, comfortable mix. You want your SA fixed income miners where they do, and then offshore currency part, stroke equity, being able to flexibly manage that.
And then just a question from Charles, and I'll link it up, Lee, to your question on currency as well. Charles asking about the effect of the gold price on the SA trade surplus. Charles, I'll just add to that. It's not just the gold price, it's the gold and PGM and iron ore. All those prices are high and the oil price is low. So the trade balance is looking really good for South Africa. And that's, of course, a good tailwind for the rand. Outside of big macro risk events, a trade surplus is a good tailwind to rand strengthening. And then you've got to add to that, there's profit or kind of dividends. All the foreign companies that operate in South Africa, as soon as they earn their profit and they can take it out the country, they don't store it here. They remit it back to the mothership. And of course, profits are low, so there's not as much remittance. And then at the same time, foreign owners of South African assets have dropped. So they've sold our equities and they've sold our bonds. Therefore, there's less remittance of dividends and interest back into foreign hands through selling rands, buying dollars, and then even to the extent that our banks, which are usually big dividend payers, and our property shares have cancelled. A lot of them have cancelled dividends. They got zero dividends. There's a lot going in favor when it comes to our current account and trade balance for South Africa, and that's what we think has supported the rand's strength coming into coming off those weak levels towards 19 to the dollar and to where it is now. So we think that you really have to take cognizance of that. Yeah.
If I can chip in with that, when the rand blew to 19, we were obviously the currency move pushed our foreign exposure to about 36%. We acted back quite quickly. We moved around once or twice, but we backed down to 20% offshore exposure in value trend 15 in stable fund. But it's actually about 21, 22. But you've pulled it right back down from the 30, just because it's fairly. In fact, South Africa being in a recession is some way good for the currency. So shorter term, it does give us some leeway to fix some of our problems because you start running a major trade surplus. Most of our debt is in rand as a country. It's not in dollars. We don't have big dollar or foreign denominated debt. So that's why we're happy to own 35% duration at the moment, which is a lot for what we're trying to do. But never assume there's no risk. That's what we're doing. Okay, that's great. We're comfortable there, but you've got this tussle coming between Ace Magashule and Ramaphosa. It looks like the good guys are getting on top, but don't totally. Ace loses, he goes to jail. So expect some internal political wrangling. There's stuff that can go wrong, and be positioned for if stuff goes wrong, you can live with it. So it's to have 100% in 10-year government bonds, we think would be stupid. You can't live with the risks there.
Just Mark Liddy asked me at the beginning of the presentation, Mark, I don't know if you're still online. Will the US COVID crisis have a negative impact on global markets going forward? So kind of how does this thing unwind? Especially in the passive funds that seem to drag the markets with them. So Mark, yeah, it's a double question in that, and 2 important points. Passives have kind of just a lot of money just flowing into markets. I think we had a slide, but we removed it from the presentation, just showing the dollar billions that have gone into the equity market on the Pfizer vaccine news. If you track ETFs, big global ETFs, it's kind of the biggest weekly investment into the markets. Net flows into equity. Sorry, it wasn't passives, but just general equity. Biggest in how long, Robert? It's like
call it 20 years. Yeah,
20 years or something. It's
yeah.
You start getting basing issues when you start going further back anyway. So basically a huge amount of money just getting pushed into the market. A lot of that goes into passives because people are trading thematically. They're not necessarily that interested in the nuances and the stock specifics. And so this kind of sentiment around COVID being quite an emotional thing, it impacts people's lives directly. It's quite disruptive, and so that impact going forward, we think all the good news on the opening up is largely priced in. So this kind of idea that the vaccine's here, well, it's not quite yet. A little bit earlier than expected, a little bit better efficacy than expected, but the market's really shot up to the extent that even South African property shares had a 20% rally. And markets do that. They just move thematically, especially when something's fallen 50, 60%. It's normal for those shares to have this volatile move. But going forward, I think there's maybe a slow drip feed of relatively negative news, but in the direction of opening up. So I'm not saying it's we're in lockdowns forever. I'm certainly not our view. We've always viewed COVID as ending. It's not Armageddon. But what the market's pricing in versus how we think it unfolds, we think there's risk to the downside. There's still risk of some localized lockdowns, some more kind of restrictive social distancing, and of course voluntary social distancing. It doesn't have to be the government that says you have to social distance. Some people choose it themselves, and therefore that impacts economic growth. And a very important point of the second wave, everyone has bought their new MacBook. Everyone's kitted out their home office already. The companies have already paid for a lot of the adjustments. So a lot of that growth that you got in the first wave of the readjustment due to the lockdown, that readjustment doesn't necessarily happen the second time. And at the same time, you have less stimulus. So the impact is messy. It's not clear-cut economic recovery from here. There's a risk that as COVID unwinds, it's just this negative drip feed of economic news and downgrading of expectations. And that's why we've got our scenario of a range-bound, volatile market and or downward risk with only a little bit of upside probability on kind of a new bull market from here. You'd have to have everything going right for a new bull market, which we think is unlikely.
Yeah, and the other point is retrenchments haven't happened yet. They'll start happening now because it was sort of considered poor form to retrench someone during it's like firing somebody when they're sick in hospital. It was sort of economically, so that's still got to happen. And then often a lot of the strains are seen further down the line. I'll give you an example. China, there's a lovely company there called China Brilliance. They were the JV partner with BMW for China. Very successful company. We actually owned them at one stage. But here's the problem. And then BMW bought out their share of the JV. So it was always, you looked at their balance sheet, there was a massive amount of cash. So it was, it's fantastic. You're going to get a huge kind of special dividend out of this thing. We'd left that party, we don't own it. But then last week, so it's sitting with this balance sheet with a massive amount of cash, but now suddenly last week, I think early this week, they can't repay their bonds. They're defaulting. So you get these stresses and strains that sort of seemed okay and come out the system. So you're still going to get a lot of that. Where bankers need to look after the bank. And whereas 3 months ago, it was fine, don't pay your debt. So there's some healing, but there's also some reckoning that needs to come because, there's thousands of businesses, tens of thousands of businesses that has gone bust, have closed since this thing started. That reckoning hasn't really come into the system yet.
Just a more philosophical question, but it's a nice question from Spalding Fourie. What skill set and access to tools is required for you as a fund manager to be successful in today's market? And are there areas where you need to buy in skill or info? So this fundamentally is a really important point. Rob had a slide up earlier. What's Rezco all about? We're all about risk-adjusted returns, and we think that as markets have changed, as technology has become more accessible, and there's been these developments in technology, Rezco very much is investing significantly in tech and tools, and we have been for the last number of years, and we've always been very tech focused. So one of the reasons why we think we're in a good space is being a mid-sized manager. We got a team of 5 serious engineers. I mean, talking Harvard MBA, kind of top at Cornell, top PhD Chem Eng, top in class maths, applied maths kind of people, really, really sharp, clever guys on the team. And we're investing heavily in that team, both as people, as you said, you buy in skill and info, investing in systems and technology and data. And we think you need that. You need that skill set and that tool in today's market. It's not the same market where, you read, it's good fun. Go read Intelligent Investor again, classic investment book where you go in to see the CEO and he makes the Sami himself. His carpets are clean, but cheap, and he's just running the business smoothly. The net asset value is 20% above the share price. It's got a PE of 7 and it's got earnings growth of 20%. Like 30 years ago, that happened. And you could go and just kick the tires with management and find those businesses and so forth. The markets, obviously, with technology and with more competition, has competed away those kinds of sitter type earnings growth, PE, quality, value shares. And that's why I think one of the reasons as well, you see value, how it's underperformed growth as a style, is the technology and the competition in the market's changing, and you need to invest with it. Now, as Rezco, as a kind of mid-sized manager, we can afford to, and we're very invested in this idea of building out this technology. We think it's not necessarily essential. We see it as essential to our business because our strategy, but it's a key input into the investment decision-making process, whether it's machine learning, which obviously gets spoken about a lot, but it's not just machine learning. It's having the right technology, the tools, the cloud tools, the charting tools, whatever it is, the research platform, work management flows, whatever there's a lot of tools out there that are really useful. So I think that's really important, and we take that quite seriously in what we're doing. I don't know, Rob, if you probably want to add on to that.
Yeah, we've got a big budget that we spend a lot of money on. We've got, fortunately in the business, John Craner is one of the senior people, been with us a while, the Shell, and he's probably the best investment tech person in the country. It's sort of the feedback we get when people do due diligences on us, that, wow, your investment tech is better than anything we see anywhere. But a small innovative team, obviously got really, really decent budget that you can build these tools that'll really give you edge. And we see it, we use the analogy of, like a spreadsheet, and I'm old enough to be in investing just as spreadsheets came out. So I can contrast the thing is, you had the days before spreadsheets, you worked it out on a piece of paper, in fact, a paper spreadsheet. You worked it all out. And then the first guys got spreadsheets. You actually had an advantage. You had to have spreadsheets. It didn't make you a good investor. but it means you could build a model for a company and change one number and all the other numbers changed, which is fantastic. You couldn't compete if you didn't have it. And that's equivalent to a lot of these tech tools that are coming. We just think it helps you to make your decisions and react a lot quicker. You know, you really we want to be like the Formula One driver driving the best car. You're just being fed this best information and you can make your decisions quickly.
Probably just Charles asking about QE, money printing, Bitcoin. There's some questions on gold. Of course, with all this money printing, Charles, people start losing trust in the underlying assets that's being printed. If you can create something from nothing, what's it worth? And so, but we must bear in mind being a little bit careful of going too extreme on those kinds of views. It doesn't normally happen in such a kind of exploding fashion. All of a sudden money has no value and you just need to be in Bitcoin. I see you saying you really don't like Bitcoin. The point being is virtual currency can also just be created. Whether it's Bitcoin, Ethereum, another version of Ethereum, or there's all sorts of virtual type currencies, blockchain technologies that can have these coins and currencies and so forth. So it's not necessary that those are in limited supply as well. And nor is cash, and nor equities. Equities can also be issued. So this idea that you can create these assets out of nothing, one must just be careful. You know, the idea that, okay, well, cash is trash, just buy equities, at least you know exactly what you're getting. And yeah, but companies can also issue shares. So not to such an extreme extent. So the point I'm making is the arguments around money printing are more nuanced and take more time to work out than maybe you know, a very emotive journalistic article might suggest. That being said, we are concerned with the degree of money printing, and we are concerned over the long term around the value of cash and zero interest rates and so forth. That being said, when the market's falling, cash is wonderful. So this idea cash is always trash, you're going to get better returns. Just don't own cash, own anything but cash, because cash gives you zero, therefore everything else has to be better. Equities can give you negative, and then all of a sudden cash is wonderful. So there's more of a flexible approach, a risk managed approach when it comes to cash and when it comes to Bitcoin. We obviously don't invest in Bitcoin. Yeah, that's not even in our universe. But when it comes to gold specifically, where we do have an investment in some gold mining shares in the funds. Okay, I've still got a few more questions. Still over 100 people on the call. We're happy to keep taking questions. If this was in Cape Town, I would have been up at 4 in the morning and flown through. Actually, I would have flown last night just because I'm a risk-averse person and I'm scared my flight will be late. So this is very time efficient for us. We're happy to chat. There's still a few more questions. Send them through if you'd like to. Jan Hendrik, I see you raising your hand as participants. I don't know if you're doing that on purpose, but feel free to pop a question in the Q&A. Something we haven't touched on, Rob, Troy Donaldson just asking about our view on Asia Pacific equity markets. Now, obviously the background, I'm sure backing Troy's question as well, has been with COVID and lockdowns, just East Asia broadly, China obviously included there, has managed COVID substantially better for many reasons, which we don't need to discuss now, but they've managed COVID a lot better, and so their recoveries are more robust. And what do the equities look like there? Now, just bear in mind that those equity markets are often export-centric. A lot of, so if you go South Korea, a lot of kind of chip companies, Taiwan. We don't invest directly in China, obviously, but Hong Kong, again, a lot of tech shares there. There's some increased risk around Chinese tech, that antitrust, a little bit of pressure on those big companies and so forth. So while the economies internally seem quite robust, and the equity markets have rallied, and a lot of tech shares within those equity markets have rallied, there's still quite a lot of risk broadly in equities. And especially because those are export markets. So if you think Europe and the US economies are going to do worse than expected, those East Asian kind of countries exporting into Europe and the US are going to have headwinds. And the tech shares we think have overshot kind of reasonable valuations. They're just a bit too expensive. Or another way of putting it, when you say something's too expensive, you can just say all the good news is in the price. So you'll kind of, the risk is a little bit of bad news and the share price falls. We saw that with Tencent, obviously it impacts us here. South Africa, a little bit of bad news. I'd argue probably a lot of bad news actually with that antitrust coming out of China. You know, the share can take a 5-10% knock on the news quite easily because it's so expensive. You don't necessarily get it back. So there's some drawdown risk there. So we don't have a lot of exposure.
You're just one on that chipping
Asia.
in. The big Naspers 10-cent thing on the VIE structures. For those who are not familiar with the term, it's you don't own, if you own 10-cent shares, Naspers 10-cent shares, you own through a convoluted structure through a tax haven into the country. You own part of a contractual interest in the IP. You don't actually own anything. And those structures were kind of illegal, semi-legal in China. The Chinese government have put their hand up that they're a bit sketchy about it. Now, some of the people say it only applies to new VIE structures. The point in a very nationalistic, assertive China, you don't actually own anything, and you need to be reminded of that fact. So you've got to be a little bit nervous of a massive holding to Tencent, Naspers, whatever.
And probably just the last question to finish off. So another one just actually popped in, so maybe two more we can quickly do. From Andrew Nicholson, just asking, it's actually in the chat, markets traditionally anticipate events by about 6 months. Is this not what they're doing now, rather than saying everything will change before the end of the year? Andrew, I think that's a great question. I'm not too sure if you're still online, but I think it's a good question for the conversation, because something that's fascinating about markets is the period over which it's discounting information. Now, our view is the markets usually come to some kind of efficiency, but what's really interesting is that period that it's discounting can move. Can look far ahead, it can look very near term, and so forth. And of course, there's emotion and behavioral biases that have these overshoots and undershoots and so forth, as we know. And so what's happened through COVID, and something which is where we've got it wrong, is the market's actually probably narrowed its view to even 3 months. Very, very short-term focused. So, hey, there's a horrible recession, but everyone's stuck at home, so they're going to have to buy more kits, more laptops and iPads and so forth. So everyone's going to front load their purchases. You're going to buy your extra iPad and for the kids. You're not going to buy another one next year. You don't buy an iPad every year. Well, most people don't. They pretty pricey things, right? So you front load your expenditure within a 3-month, 6-month window. Of course, all your numbers look better, but in a recessionary environment, you smooth it out and your outcome's not as good. But if the market's only looking 3 months ahead, you get this massive beat relative to expectations, because it's not smoothing that out over time. And so that's been fascinating about this kind of COVID crash, then the rally. We think the rally has overshot. And the reason why we think it's overshot has been because the market's discounting very short periods and not looking ahead at the messy unwind of the scenario as stimulus gets pulled, as interest rates maybe have to normalize and so forth. And so yes, the market's very short term, but I don't think that, to the comments, I don't think the market's always going to be like that. At some point, the market can just flip back to a 3-year horizon and say, hang on, whoa, in the next 2 to 3 years, interest rates are going to have to go up 150 bips. How are we going to handle this? And the market could panic and fall on that. So this kind of, the period that the market discounts isn't static. And that's what's fascinating, one of the fascinations of markets. And also where I think the big driving force in the short term, why it's so volatile and why markets have rallied so hard. I just want to because there's a question coming, I just want to make sure we're clear on it. Rob is sounding caution around income funds. How immediate is the danger? Okay, can you expound on this, please? I think maybe we just clarify.
Okay, can I just clarify that?
Yeah, I think so.
An income fund that sticks everything 100% into 10-year government bonds, okay, is being reckless. I'd be very cautious of that. Income fund, the problem you have going forward on income funds is a guy's taking a sort of a decent risk and being conservative on the amount of duration that they're prepared to have. You're looking at a forward-going return of about 6%, 5.5% to 6%. And that's essentially the problem on income funds. You're not going to get the 9% returns. You're going to get more like the 5.5% returns. If there's an income fund there that's got 100% in 2030 government bonds, I think you should. I think that's excessively risky. That's really what we're trying to say on that. And most are responsible, and they're taking a mixture. Hence, you end up back at getting more like 6%, 5 to 6.
Yeah, great. Right? So I thought you'd want to just clarify. Yeah, so just to be clear there. Okay, so I've answered kind of the most substantial questions. So I'll hand back over to you, Rob.
Yeah, so just thank you to those who are still there. We really appreciate your time staying in so long. Hopefully we can do one of these face-to-face sometime. Would really be great. And I'll pass the mic to Brian, let him say his last goodbyes. And if we don't chat to everyone, just...
Sorry, Gavin, we went over. We did say initially that you can leave after an hour, so we apologize. Yeah, thanks very much, Rob, Simon. And once again, if you have more questions or you think of some questions afterwards, or when you're watching the webinar again, just email me or info@Rezco, and we will attend to that question. Thanks very much, guys, and thank you for the support. Much appreciated.
Great.